Back to Intermediate Accounting. This video continues Chapter 21, Accounting for Leases. Remember from the last video, the Introduction to Leases video, that leases take one of two classifications. A lease is either going to be a finance or an operating lease. But regardless, all leases are reported on the balance sheet as assets and offsetting liabilities. Remember those classification rules. There are 5 questions that the company must answer in order to determine whether the lease is going to be classified as finance or operating. If any one of these questions that are shown here can be answered with yes, then the lease is going to be recorded as a finance lease. If all of these questions are answered with no, then the lease would be classified as an operating lease. This video is going to focus on the accounting for finance leases. For a finance lease, the lessee recognizes interest expense on the lease liability over the life of the lease using the effective interest rate method. And for their finance lease, the company records amortization expense on the right of use asset. And generally that amortization expense is going to be recorded on a straight line basis. Look at an example of a finance lease. Assume that Caterpillar Financial Services and Sterling Construction sign a lease agreement dated December 31st, 2019 that calls for Caterpillar to lease a backhoe to Sterling beginning the same day, December 31st, 2019. The terms of the lease agreement are shown on the next slide. The lease term is 5 years. Lease agreement is non-cancelable, requires equal rental payments of $20,711 on December 31st of each year. The backhoe has a fair value at the start of the lease of $100,000 and an estimated economic life of 5 years. The lease contains no renewal options. The equipment reverts to Caterpillar at the termination of the lease. The lessee's incremental borrowing rate is 5% per year. The lessee depreciates its assets on a straight line basis. And Caterpillar sets the annual rental rate to earn a rate of 4%. So there's an implicit interest rate of 4% on the lease, and Sterling, the lessee, is aware of this rate. Let's start by looking at the criteria that determine whether a lease is operating or finance. Classification 1, is there a transfer of ownership at the end of the lease? And the answer to that is no. Is there a bargain purchase option that we can expect the lessee to take advantage of at the end of the lease? We didn't see anything about that, so the answer is no. Is the lease term 75% or more of the economic life of the leased property? Well, the lease term is 5 years, and the economic life is 5 years. So that's 100%. So this automatically, we can stop there, this automatically makes it a finance lease, but let's just look at the next 2 criteria. Well, how does the present value of the minimum lease payments compare to the fair market value of the equipment being leased here? Is it about 90% or more? Well, the present value of the lease payments is $100,000, and the fair value or fair market value of the leased equipment is $100,000. So there's a second criteria that causes it to be a finance lease, not that that matters. As long as one of these items is yes, then it's a finance lease. There is an alternative use to Caterpillar. The asset's returned at the end of the lease. So yes, there is an alternative use, so that means it is not a finance lease according to this criteria. But as long as we have one yes, we know that this is a finance lease. Now let's take a look at the lease accounting from the perspective of the lessee. Sterling is the lessee. They compute the lease liability amount, well, just using present value information. What's the present value? The interest rate is 4%. We see here Sterling uses Caterpillar's implicit interest rate of 4%, not its incremental borrowing rate. As long as that implicit rate is known, that's what's used to determine the present value of the lease. The lease term is 5 years, so we have the number of years 5. We know what the lease payment is, $20,711. There's no residual value guarantee, so our future value from Sterling's perspective is 0. There's no value at the end of this lease. And we need to put type as 1 because payment is due at the beginning of the year. So we get a present value of the lease asset and liability, $95,890,000. So Sterling, the lessee, needs to record the finance lease on its book at the date of inception of this lease. December 31st, 2019, Sterling records the lease asset, and that lease asset is titled right of use asset at the present value of those future lease payments, $95,890. And the company also records this lease liability. Now notice that this lease liability of $95,890 is greater than the total lease payments. Each lease payment is $20,711 for 5 years. So the lessee Sterling is going to make total payments of $103,555, but this lease liability is recorded at $95,890, the present value, not the total amount of all those future cash flows. What's the difference? That difference is going to be attributed to interest. Before we get to the interest component, because remember, we can't record interest until time has passed. It's December 31st, the day the lease was signed. We recorded the asset and the liability, and we need one more entry because the lease terms say that the first lease payment is going to be made on that very same day that the lease is signed. So that cash payment, we're going to credit cash to show that Sterling reduces cash by $20,711, and the other side of that entry is a debit to a lease liability. So we are reducing that lease liability by making payment on the very first day that that lease is signed. So what is the balance in the lease liability at this point? Well, we recorded it at $95,890, and then we reduced it by the total amount of that first cash payment. In the future, there's going to be some interest component of these cash payments, but because this first cash payment is made on that very same day, there's no interest component because no time has passed. So the lease liability is $75,179 after these two entries are recorded. And we see that here. The first lease payment is made the first day of the lease, so the lease liability is $75,179. So time goes on, then it's December 31st, 2020, and the company needs to record another journal entry. It's one full year has passed. It's now December 31st, 2020. The company now needs to record interest expense. The interest expense is equal to that lease liability of $75,179. Because think of it this way, it's kind of similar to the company having borrowed $75,179 on December 31st, 2019. And borrowed money over time results in interest expense. So the amount of our interest expense is equal to $75,179 multiplied by the implicit interest rate on that contract, 4%. So the interest expense is $3,007. We know that the cash payment that is going to be made on December 31st of every year is going to be $20,711. And that difference between the cash payment and the amount of that cash payment that relates to interest results in a decrease to the lease liability. So we decrease or debit the lease liability, $17,704. What's the balance in the lease liability at this point? What was our general ledger report? Well, right before this entry, it was $75,179, and we just reduced it with a debit to lease liability for $17,704. So that results in a lease liability of $57,475. And since it's December 31st, 2020, that's what's going to be reported on the balance sheet. But there's one more journal entry the company needs to make before it puts together its balance sheet. Remember that the company recorded a right of use asset. Well, over time, that right of use asset is going to be depreciated, except that we call it amortization. If we own it, we depreciate it. If we lease it, we amortize that right of use lease asset. So an entry is recorded to debit or increase amortization expense. The company uses the straight line method. We're taking the balance in that right of use asset, 95,890, and we're allocating that across 5 years. So amortization expense is 19,178. And we're reducing that right of use asset by 19,178. So what would the financial statements, the year ended 12/31/2020 financial statements report, we would have under the asset section, we'd have this right of use asset, typically abbreviated ROU asset, equal to, well, we started it at 95,890, and we recorded this adjusting entry to reduce the asset by 19,178. So the balance in the right of use asset is 76,712. We said that we had a lease liability with a balance of 57,475. That's going to be reported on the balance sheet. And what would the income statement report for the year? It's going to report two separate expenses. Think back to these two journal entries we recorded. We had interest expense for 3,007 and amortization expense for 19,178. I'm going to write amortization expense first because that would be reported higher up on the income statement. That would be part of operating income. And then in the non-operating section of the income statement, the company would report this interest expense of 3,007. Now let's move on to how do we account for, when it's a finance lease, what is the accounting from the lessor, the company that has the equipment initially and it practically sells it to the lessee. This is called a sales type lease. The lease classifications are the exact same, whether you're talking about the lessor or the lessee. But the lessor has transferred control to the lessee, and so we call this a sales type lease. If it doesn't transfer control, then we would call it, then it would be considered an operating lease. But right now we are looking at accounting for this sales type lease. So this is like a finance lease from the lessor's perspective. The lessor accounts for the lease similar to the sale of an asset. The lessor records a lease receivable that's typically equal to the fair value of the asset being leased, and then it takes that leased asset off the books. Let's return back to that same exact example, but now let's look at the accounting treatment from Caterpillar's perspective rather than Sterling's perspective. Remember, the lease term is 5 years. The equipment that's being leased has a fair value of 100,000. Annual lease payments are 20,711 beginning on that inception date of the lease. So we're told that the lease receivable is equal to the fair value of the equipment on the lease commencement date. What we need to do is record that journal entry that's necessary on lease commencement date. 12/31/19, Caterpillar is going to record a lease receivable in an amount of 100,000 and sales revenue. Caterpillar is recording this as if it's a sale. And what happens when we record sales revenue and we're giving up equipment? We record cost of goods sold and a decrease of inventory. We're told that the cost of this backhoe is 85,000. And then there's one more entry to record on that first day because that first lease payment is going to be received by Caterpillar on December 31st, 2019. So on that same day, the company is going to record the receipt of the cash of 20,711, and the company is going to reduce that lease receivable by 20,711. So the same way that we tracked the balance in the lease liability, we're going to do something similar each period and track the balance in the lease receivable. Remember, the lessee was recording, the lease liability was driving interest expense. The lease receivable for the lessor is going to drive interest revenue. So the lease receivable, first we booked it as 100,000, and then with the cash payment, we reduced it by 20,711. So the lease receivable now has a balance of 79,289. How from the lessee's perspective, after a full year passed, the lessee recorded interest expense at the time that they made the cash payment, and that difference went to a reduction of that lease liability. Now we're going to switch this around. From Caterpillar's perspective, they are receiving the cash. So on 12/31/20, at the end of the first full year, the company receives the cash payment of 20,711. They're going to record interest revenue because it's as if they have lent out this balance here of 79,289. It's as if they've lent that out at a rate of 4%. So interest revenue is recorded for that first full year of 3,172. And that difference is going to be credited to that lease receivable account. So we are crediting to reduce the lease receivable by the difference. What's the balance in the lease receivable at this point? It was 79,289 before we booked this journal entry here. And when we booked this journal entry, we reduced that by 17,539. So the balance in the lease receivable account is going to be 61,750. And that's what's going to show up on the balance sheet at the end of the year. So the balance sheet for December 31st, what is it going to report? It reports that lease receivable that we just calculated for 61,750. And the income statement is going to report, of course, the interest revenue of 3,172. Now, I didn't prepare the income statement at 12/31/2019, but of course that one would report the sales revenue as if we sold the equipment and the cost of goods sold. So we would see gross profit in 2019, but we would see the interest revenue in 2020 and every subsequent year until the lease ends. There would be this interest revenue earned.